Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Alrighty, welcome to the Smart Investing Show. I'm Chase Wilsey, and I'm going to be your host here for the next hour, getting you through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. You want to join the show later? Phone number here is 833-288-0973. Again, that's 833-288-0973. And got a special treat here today. Brent, as you can tell, is not in studio, so I have our CFP, Harrison Johnson, here with us. Hey there, Harrison. How we doing?
Hello, everybody. Usually you hear me calling in from all over the place, but now I am back in the studio for the first time in a while.
Been a while since you've been in the studio, so good to have you here. And, if you want to call in, most time, as people, our listeners know, we break down those stocks. But, hey, if you have more financial planning questions, maybe around taxes, estate planning, stuff like that, you can call in, and Harrison is here to help address those. But as always, if you want to call in about individual stocks, what's going on in the market, be sure to give us a call. As always, a lot going on in the stock market, the economy, a big news in the economy this week. A lot of different reports came out. We saw CPI, PPI, the consumer price index, the producer price index, and then also retail sales came out. We also started earnings season. So I think this is going to be a really interesting next few weeks as you start to see more companies start to produce those earnings reports. We saw the big banks like Citibank, Jpmorgan, Wells Fargo. They all reported this past week, and there was some, I'm going to say, inklings of concerns to be there, but hey, there's always concerns out there in the economy. I did think a lot of the reports were actually quite strong. There was a lot of positive news that I thought the banks produced with how strong the consumer still is and how strong businesses still are, and still the lack of leverage out there is one of the big things that I look at. But as always, we do have our topics we're going to look at here. We're going to talk about inflation. We know we talked about the CPI, PPI. Let's take a closer look at those numbers here. And I got to say here, another month, another extremely high inflation rate. The CPI came in this past week for the month of June at 9.1%, which topped the estimate of 8.8% and was the highest level since November 1981. Energy inflation was top of mind yet again as gas prices climbed close to 60% compared to 1 year ago, and even electricity prices grew 13.7% over the same time frame. Also, natural gas, well, that was up 38.4%. Food prices, another big part of our lives, remained hot as they rose 10.4% over the last 12 months. And you look at the shelter index, that was up 5.6%, which was the highest level since February 1991.
One area that is seeing a reprieve from what I believe is more difficult comparisons is car prices. The cost for new vehicles was up 11.4% compared to last year, and the used car and truck index was up 7.1% during that same time frame. Remember, recently this was around 30%, so much higher. With that said, I still believe inflation will be lighter as we exit the year, but all lighter means is not as high. We have started to see some reduction in commodity prices, which could help with the input costs for companies and could slow the CPI in the months ahead. Remember, it takes time for these various costs to work through supply chains and the overall economy.
And this is so important, too, because when you look at the CPI, a lot of people talk about, housing costs, and you're comparing against, people talk about inflation is much higher than it really was in the 70s because you're looking at different things. And one thing is that housing prices, the way that's calculated, and we've talked about this a lot, but it's so important to understand when housing prices were spiking and you were seeing, gains of 17, 18, 20% in some markets for the housing prices year over year, that's not baked into CPI. The way CPI looks at it is actually a renter type an owner calculated rent. So you're not looking at the home prices, it's how much you could get for renting your home out, essentially, is how the CPI looks at it. So rents weren't growing as fast during the last couple of years, but I think that creates more of a long runway. And now you're seeing this 5-6% run rate on the shelter index, which occupies about a third of the index overall. I think that's one reason you're going to continue to see CPI remain quite high, is I think people are going to need to continually increase rents, unfortunately, which sucks for renters, but they were buying houses at these high prices to offset the cost of the prices for the homes they were paying. You got to increase rents. And I think that's going to keep coming.
Yeah, I mean, rent always seems to lag a little bit behind property value. So property value shot up over the last 24, 36 months, and now we're starting to see those rent prices come up. So, yeah, I definitely agree.
Yeah, so you got to watch that out for the CPI. And we talked about the PPI as well. And this is something that we always want to take a closer look at because this is what businesses are paying for their products. Again, the input costs. And I always tell people, companies are not just going to take prices and say, oh, well, that sucks. I'll just eat that cost. No, they're going to pass them on to the end consumer. So a lot of times the PPI is a good kind of leading indicator for what could be ahead for that CPI. But with that, the numbers for the producer price index remained around historic levels. In the month of June, headline PPI was up 1.1% compared to the month of May and increased 11.3% compared to last year. The recent all-time high was 11.6% in March. Of the month-over-month gain, almost 90% came from a 10% increase in final demand of energy. So this is something that's very huge.
One positive note was the core PPI, which excludes energy as well as food and trade services prices, was up 6.4% compared to last year. This was a deceleration from May's 6.8% gain and off the 7.1% gain we saw in March. Unfortunately, with these elevated prices, the higher costs will likely continue to be passed on to the end consumer.
And this is something, too, when you look at inflation, I hate to say it, but it is so energy-driven. Energy still runs our economy. You look at diesel prices. You look at gas prices. People are having to spend so much money on gas, it hurts other areas of the economy because they don't have as much discretionary income. But from the business side, everything has to be transported. If you're buying something overseas, well, it has to come across the ocean, maybe by plane, maybe by cargo ship. That takes fuel. We don't have those electric planes or electric ships just yet to transport that. Well, now that's a cost to those companies, so then they have to pass that on again to the consumer. This is one thing that I believe energy, if it can reduce itself here shortly, I think inflation is going to be a lot less of a problem. But the problem is I don't know if energy demand is necessarily going to tail off just yet because all the money in the economy, which is why we continue to believe, again, that inflation is going to remain high. But I was going to say there are some positive notes here. When you're looking at the recent records, you're still seeing huge year-over-year gains. Don't get me wrong there, but things have pulled back from the highs. I mean, this was as of the end of June, but you look at natural gas, that was off 65% from its recent high. Lumber, one thing we talk about is home prices. Lumber was off 60% from its recent high. Look at things like cotton, down 54%, wheat, 32%, copper, down 25%, gas and diesel around 16, 17%. So we have seen some things pulling back from their highs, which is one reason why I do think if this was not the peak inflation rate that we're going to see, I think we are near that peak inflation rate because I still believe as we exit 2022, you're going to see an inflation rate around 5%. That's my prediction because I don't believe we're going to maintain as high of prices. I think we're going to start to see some of those come off those record levels. One other thing, too, that the inflation rate is really concerning investors is because of the Fed. And the Fed, they're worried about rising interest rates. They're worrying about what's known as quantitative tightening, where they're letting bonds run off the balance sheet. And we're going to get more from the Fed meeting here shortly. But I believe that they're taking too much focus on the short end of the stick. And what I mean by that is they're so worried about raising the Fed's funds rate rather than letting bonds expire. They built up this massive balance sheet, which is known as quantitative easing, and it did help stimulate demand during COVID. So I think there was some positives that resulted from that. But now I think what they should be doing is they should just let these bonds expire. And currently what happens is as bonds mature, the Fed just reinvests those proceeds back into treasuries or mortgage securities. And what they're talking about is capping the monthly runoff at $47.5 billion. And that's going to last through about September. And this is actually occurring, it's been occurring since June. And that's $30 billion for treasuries and $17.5 billion for mortgage-backed securities. They're going to then increase that threshold to $95 billion. But But the issue I have here is if you have, let's say, $95 billion, I'm just going to make my math easier, $97.5 billion worth of bonds expiring in the month of, I'm just going to say July, you're still creating demand in that Treasury and mortgage-backed security market because you still need $50 billion worth of bonds to buy. My personal belief, I think they should just let that program expire, let these bonds run off, let the market actually set the demand for what's going on in the treasuries and the mortgage-backed securities, because right now we know that inflation is hot. I think interest rates need to find a market-driven level, and it could cause a temporary spike in rates as it tries to find itself, but I think that's going to lead to a much healthier economy in the long term. I mean, we'll see what happens. I'm not chairman of the Fed or anything, but that's what I'd be looking at here. I'd be less worried about raising those short-term rates because now we're talking about maybe 100 basis point increase. And what that's doing is it's really creating more demand on the short end of the stick. That's why you're seeing the 2-year Treasury spike and the 10 years actually not doing quite as well. And we have that inversion, the yield curve. I'd like to see just less, I don't want to call it manipulation, but less demand from the Fed and those Treasury markets. With that, we kind of talk about the recession. I mean, we know a lot of people are concerned about recession happening, and there is, I think, some accuracy in those concerns. And to be honest, we'll get some more revelations here because the GDP report does come out July 28th. And if we have a negative number, that's the technical definition of a recession, is we'd have 2 consecutive quarters of declining GDP. But I continue to believe this is an inflation-driven recession where it's just that output from GDP is not keeping up with inflation because we're not having real growth. But I don't think it's going to be that big of a problem. And I honestly think that this could be the best recession we may have seen in our lifetime. There's not enough room to really talk about here, not enough time to really talk about here all the reasons of why I believe it's going to be the best recession we've seen. But let's take a look at a couple. Number one, inventory levels at many companies still remain low. I mean, we talked a lot about the car manufacturers and so forth last week or 2 weeks ago, where you drive by these auto dealers and there's not like we have a huge surplus of cars on those lots. I mean, that's a big positive. One area that you have seen a little bit more excess inventory is retail, but I don't think retail inventory is going to take down the economy by any means. You also do look at profit margins. Well, for companies, that's high, around 18%. For reference, profit margins heading into recessions in 1991 and 2001, well, they fell to single digits. So we still have a lot of room for these companies to remain profitable. That's a huge buffer that we're looking at, about an 18% profit margin. Businesses are also sitting on a record $4 trillion in cash. Jamie Dimon just this last week during the earnings call said companies' credit has never been better. Companies are in a fantastic spot. And again, I talked about that leverage earlier, about how the consumer and the businesses, they're not over leveraged at this time. And look at all that cash. Again, $4 trillion for companies, and households still have $18.5 trillion in checking accounts, saving accounts, and money market mutual funds, which is about $5 trillion higher than before the pandemic.
The job market is still very strong, and in the 12 recessions since World War II, that has never been the case. And I forgot to mention, in the second quarter, many commodities like soybeans, wheat, and corn have dropped double digits. You may hear the media and other worrywart screaming, the sky is falling like Chicken Little, but I believe this will not even feel like a recession. Let's see where we are in December 31st, 2022, but in the meantime, I'll keep my eye on the important data, not the media hype.
Yeah, and I think this is just something people are looking at, and it is concerning. Of course, you're going to have issues in an economy. An economy is not always going to be perfect, and we are going to have recessions. We are going to have rising interest rates. We are going to have inflation. Now, sometimes it does get out of control, like we are seeing high inflation rates, but you look at the overall picture. I'm not saying we're having a booming economy by any means, but we're not going to have a 2008, 2009. We're not going to have a Great Depression of 1929. We're nowhere near those levels. And I think if you start to look at the numbers behind the equation, and I think a lot of times the problem is people make it so political. And whether you're Republican or Democrat, if your party's not in office, you just hate the economy just because you don't want that person to succeed. And I think a lot of people know where I lean here, but the issue is the economy is not as bad as people are making it out to be. And again, I want to be very clear. Not great, but it's not crisis level. We're not in a leverage situation like 2008, 2009, where the companies are going to collapse, where the real estate market is just going to collapse. There's just too much cash out there and not enough leverage. With that, I did want to talk quickly about the housing market as well, because this is another issue that people are looking at, because historically slowdowns in new home construction have been a leading indicator for prior recessions. In the month of May, we did see new home construction drop about 14% from a month earlier. But before you hit the panic button, it's important to look at the lessons home builders have learned from the housing crisis in 2007.
Yeah, during that time frame, they drastically overbuilt, which has definitely not happened in this case. And in fact, in the first quarter, total U.S. spending on home building was 22% below the pace of building at the peak of the early 2000s. I believe we have an expensing housing market set for a pullback, but by no means do I believe we have a housing crisis that led to the Great Recession in 2008 and 2009. I mean, it's just a totally different environment out there. People have a lot more equity in their homes compared to what the 2008 problem looked like. Also, we've got a whole lot more buyers in the market. You know, for single family homes, it used to be just individuals buying those, but now we have a lot more investors. We have companies buying them. We have hedge funds, private equity funds. So all these other people have been increasing the demand in accumulation with the low interest rates. So it's just a totally different space that we're seeing compared to 15 years ago.
Yeah, and it's, again, the thing that worries me is when we have excessive leverage. And I think I talked about this last week, but one of the only places I think that we've really seen excessive leverage has been in cryptocurrency. We know how that's kind of worked out for a lot of those cryptos, as Bitcoin's still around 20,000, and a lot of those have just fallen off a cliff. And you've seen a couple of the, like Three Arrows Capital, they've filed for bankruptcy. There's a couple other of the, I'm going to call them custodians that have filed for bankruptcy, or lenders that have filed for bankruptcy. So that's what really concerns me, and is the leverage. And I think with all this equity that people have built up, you're not going to see foreclosures, because if the price declines and people can't afford that home, it sucks that, you're not selling at the peak anymore, but you still have, let's say, $200,000 in equity. You can sell that home. You're not underwater. I don't think we're going to have a huge problem, again, just because of all that equity.
Yeah, I mean, back at that time, people were getting negative amortization loans. They were buying multiple properties with variable rate mortgages. They were qualifying with nothing down. So you're right. It was much more of a leverage problem. And, there's just too much equity out there in the real estate market for something like that.
And talking a little bit about the real estate market, I did want to talk about mortgage rates real quick, because people have been worrying about the increase in mortgage rates, but historically they are not out of control by any means. In fact, if you go back to 1971, the long-term average for 30-year mortgage rates is just under 8%. And the record high that came about in 1981, 16.64%. Nowhere near those levels. At around, I'm going to call it 6%. I believe it's dipped lately to around 5.5%, but still many people are probably paying close to 6%. I'd say we now have a more normalized interest rate environment. And the days of getting under a 3% mortgage, I believe, are in the past. I don't think we're going to see sub 3%. Perhaps for decades. I just don't think we're going to get back to those levels.
I mean, those low interest rates were artificial by the things that the Fed were doing. So I think you're right. It's going to be a long time, if ever, that we see those again. But as you mentioned, higher interest rate aren't necessarily a bad thing. Yeah, it's nice to be able to buy a house for a 2% mortgage. But with the higher interest rates, that interest is deductible if you itemize on your taxes. So even if it is 6%, 7%, well, that's a deduction on the federal and state side. You can write that off. So that the after-tax interest rate still might only be something in the 4%, which is very doable, especially if you buy a house at a good time and you still get that growth there.
Yeah, no, great points there. And one thing I was thinking about on the drive here today was I was thinking about just talking to people, and obviously a lot of people are concerned about where stocks are, where their portfolio's at, and so forth. And I always tell people, we're not worried about the companies we own in the portfolio. We know where they're at. And, I mean, there's still issues that people have with the volatility and so forth. And it just doesn't drive me crazy, but I always look at it a different way. When people are worried about reductions in the stock prices, I always kind of look at it this way. I say, let's say you bought a stock at $10 a share. Well, 7 years later, you sell it at $20 a share. Well, it doesn't sound that great, but that's a 100% gain. That's a pretty realistic return. After that 7-year period, you don't look back over time and be like, well, after a year, gosh, it was at 8, and then, after 2 years, it was at 12, and then it fell back down to 11, and then up to 15, and then back down. No, you look at, you bought it at 10, and you sold it at 20. But all this volatility, it just worries people. And this is, again, where you have to look at understanding what you own, and you can't get sucked into the stock market volatility. And don't get me wrong, I think there's a lot of things out there that you shouldn't play what I call the pray and hope game, where hopefully it comes back. But with good companies with strong valuations, there's no reason to panic about the stock market volatility.
Yeah, volatility is the nature of buying companies. It's always going to go up and it's going to go down and it's going to go up again. But you're right, as long as you're buying the right things, that's really what you focus on. In the long term, it works itself out.
Yeah. Well, with that, I do see Ken and Jim have been waiting patiently here. So we're going to, again, open up the phone lines. If you do want to call in, again, that phone number is 833-288-0973. Again, that's 833-288-0973. And I did want to mention real quick is if you did find that kind of first part of the show informative, interesting, that is part of what we call our Smart Investing newsletter. We do our financial posts with these topics all week on social media. But if you want to get that newsletter, there are more topics that we don't have time to cover here. You can go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. But with that said, let's head to San Diego and let's speak with Ken. Hey there, Ken. You're on the Smart Investing Show. How can I help you this morning? Ken, you there? Alrighty, well, it looks like Ken may have stepped away from the phone. So with that, let's go out to Alpine and let's speak with Jim. Jim, you're on the Smart Investing Show. How can I help you?
Chase, you've been a great help already with that monologue about how really good and how liquid the whole economy is, how under-leveraged. It's very reassuring, especially in this great buying environment.
Yes.
Mark. So I called you a couple months or so, 2 months ago, about the health industry. I'm just curious if you have any news or information or thoughts about why the stocks keep going down.
Okay.
It's becoming, quote, better and better buy, but, I got to trying to figure out what's going on behind the scenes without reading the news and everything.
Of course. Yeah, so let's take a look again at Omega Healthcare Investors. That ticker symbol here is OHI, and they're a REIT, which is, again, a real estate investment trust in the healthcare facility space. So I'm guessing here that they probably own some acute care centers, maybe some hospitals and things of that nature. But big thing here, short percentage of float, 12.1%, a lot of short here on this stock. Now, that could be one thing that's pushing the stock lower, but on the flip side of that, if things can start to turn around, those shorts could become uncovered, and those people have to then buy the stock back, which could actually lead to a short squeeze, setting the stock higher quite quickly. So that, in my opinion, could create a good opportunity with a good company. Looking at institutional ownership, well, that's 68.5% here. Valuation ratios, price to earnings 16.4 when the industry is 28.5. Price to sales at 7.2, slightly above the industry at 5.4. Price to book at 1.8. Industry average 1.6. Not going to fret about that ratio there. Price to cash flow 11, much better than the industry average is 17.2 as well. Now looking at growth rates, earnings over the last 1 year, well, they're up 103.3%, while the industry is up 10.6%. Many times in real estate, that could come from selling a building or selling a property. So would want to understand how the earnings grew so quickly. But as I said many times, that's going to be my estimation of why that occurred. Sales over the last 1 year, well, hey, that grew 13.6%. Industry was up 14.8%. So pretty good growth rates for this business. 5 year, though, estimated earnings per share growth, that's a negative 2.7%. Looking at the dividend, wow, 8.8% dividend yield. That is definitely a juicy one there. Payout ratio, 144.1%. Now, that is concerning on the earnings front. But again, one thing we always talk about with the real estate investment trust is you got to look at what we call the FFO. That's the funds from operations, or the cash flow of a company, because there is so much depreciation that can occur with these real estate properties that the earnings are not necessarily as good of a gauge, perhaps, as how strong the company could be. Now, looking at the balance sheet, current ratio, well, very strong there. Plenty of liquidity, 2.8. Debt to equity at 1.4, 140% is above the industry average of 100%. But many times with this, we know that companies, the real estate, depreciate their real estate over time. So the debt to equity may be more favorable than you think, because they're carrying the book value of the real estate, not necessarily the market value many times, which could undercut how strong the balance sheet is for these businesses. Now, looking at the net margin, 43%, very strong compared to the industry average of 19.7%. And then the return on equity, 11.4%, and return on invested capital, 7.1%. I do see the current price here for OHI, $30.40, 52-week high, well, $37.96. And the 52-week low, well, that's $24.81. See, year-to-date, stock's up about 8%, so it has been falling from the recent high, but definitely held up much better so far this year than the S&P 500 index, which is down about 18%. Now, if we go forward and we look at the estimated earnings here for the company, I do see that they're estimated at $1.49. That would give us a target sell price here of $24.73. Let's see, and I said the current price was, again, $30.40. And excuse me, Jim, that was actually the earnings for the company, not the FFO. I have to pull up my other resource here to pull that up. The one I had pulled up only pulls up earnings, unfortunately, so I thought I was going to, let's see, just pull that up here. So OHI, looking at the earnings going forward, and kind of while I'm pulling this up, one thing that I have noticed with the healthcare space is there is a lot of other concerns. I've seen a couple of short reports of other healthcare companies, healthcare facility companies, I should say, that have sent other stocks in the space lower. Just people have kind of pointed out to the margins these hospital operators operate with. That has caused shorts on, I know, another stock in particular. We actually own it in the portfolio, so I'm not going to give the name of that one, but people can probably do the research and find out. But I know that that's kind of created some gyration in this industry in particular, so I think that the shorts from other places have kind of carried over into OHI. That is my estimation of why this stock has fallen from the highs. But I think a lot of the short data that this firm has presented, in my opinion, is not really too concerning. I think that they're missing a lot of a data that I think is just inaccurate. And if you listen to the companies talk about it, I think there's a lot of positive things going on with the space, and this type of real estate I think is a very safe type of real estate. I don't think we're going to have hospitals go anywhere. So I like this space. I think it's just kind of under scrutiny right now, which has sent the space lower in terms of their stock prices. With that, I did pull up the FFO as well for OHI. As I said, we'll go out to December 2023. I do see the estimated FFO is $3.03. Use our 16.6 multiple for that. We get a target sell price of now $50.30. So that does illustrate the big difference again between earnings and FFO, and why we do look at the FFO for these real estate companies.
Yeah, you mentioned the margins are pretty tight, but it didn't sound like it when you were reading off the numbers.
Yeah, and that's one thing. It's not the margins for the hospital real estate owners. It's for the hospital operators. So the operators, the ones obviously paying their landlords or the real estate owners. The short report actually came out and said, oh, well, this is going to be problematic because they're not going to be able to afford higher rents and so forth. But when I looked at the data from a lot of the operators, it's not great by any means, but it wasn't terrifying, like, oh my gosh, they're going to fold, go under, and not going to be able to afford that real estate.
Yeah, and it being a REIT, I mean, at least in a real estate REIT, my understanding is they have a mandatory 90% payout on earnings. Is that the same with this healthcare REIT, you think?
Yeah, so that they do still have to pass on those earnings to the shareholders. So that's why you see such a great dividend yield, and you see great dividends many times with the real estate investment trust companies.
Yeah, and with the payout ratio was 140.
Yeah, and again, that's on the earnings, not the FFO or the cash flow. So it looks very, very high, but I would obviously recommend doing more research to make sure it is sustainable. But just based off the difference between the earnings and the FFO, I would guess their cash flow can more than cover that dividend, but you do just want to ensure that.
Yeah. Okay. Well, that's the FFO. The ratio of FFO is probably down below 100%. So that's actually quite a bit below 100.
Yeah. So, well, I hope that helps you there, Jim.
Well, I'm not going to worry. In fact, I think I might just pick up a little bit more.
Yeah, make sure you're not over concentrated there. But I mean, from what I've seen, the numbers look good. I think the story's good for that space. I would want to understand again more of what healthcare facilities they own and where they're at. But I think it could be a good potential to add to.
Well, I'm getting older. I may become a customer. You know how that is.
Hey, we'll see what happens.
All right, Bill. Thanks a lot. Again, as always, it's very informative and tremendous service.
All right. Well, thanks for calling, Jim, and thanks for being there.
All right, see you later. Bye.
All righty. Well, that does open another phone line. Phone number here again, 833-288-0973. Again, that's 833-288-0973. And I see we have Ken back, so let's try this again. Let's go out to San Diego and speak with Ken. Ken, you're on the Smart Investing Show. How can we help you?
Hi, guys. I was calling about Chase, Jpmorgan Chase, and see what you guys thought about the stock.
Of course, yeah, and Jpmorgan Chase did just report this past week, so we might not have complete up-to-date numbers, obviously, since the reports aren't done, but more than happy to kind of go through it. May want to call back in a week or two as well to see if there is any changes to the numbers. Nice thing is not like year-end where it's going to drastically change it, but there could be some changes to analyst estimates and so forth. But let's take a look again at Jpmorgan Chase. Very large bank. We definitely know about them. They're in the industry of, obviously, banks. Short percentage of float here, not very high at 0.6%. I see institutional ownership at 71%. Now, turning to the valuations, very attractive for the bank at this time. Price to earnings, and again, this is the pre-report from, let's see, I think they reported Thursday. But price to earnings was 9.1. Industry was at 6.5. But gosh, under 10, that's a extremely intriguing valuation. Price to sales at 2.8 is also above the industry average 2.0. I see price to tangible book value at 1.7. Industry average at 3.2. I like that ratio there. Price to cash flow 4.2, above the industry average 2.6. It is somewhat expensive compared to the industry, but overall valuations, I would say, do look good for Jpmorgan Chase. Looking at the PEG ratio, which is the PE divided by growth, that's also very attractive at 1.8. Now looking at the growth rates, earnings did fall 10% over the last year, while the industry was down just 1.1%. One thing that you had to be cognizant of is in the last 2 quarters is now Jpmorgan Chase has actually added what we call like credit reserves, which is actually an earning hit. But it's not like you pay for them necessarily. It's not cash flow that's going out of your pocket. It's just an accounting measure that these banks have to take if they're concerned about perhaps some risks down the line. We saw big earnings hits during COVID for these banks where they had to reserve a lot of that credit essentially. Now they're reserving some more, but not nearly what we saw during COVID, obviously. So that has been something that's impacted the earnings thus far for many banks in 2022, something that you would want to understand a little bit more before investing in this company. Another thing, too, you talk about sales down 0.6% while the industry was up 4.5%. Looking at the 5-year estimated growth rate, well, that's 5.4% versus the industry growing at 2.8%. I got to say, I love Jamie Dimon. I think he does a great job running the bank. On his recent conference call, he was talking about the analysts are like, oh, well, aren't you worried about the short term? You haven't pulled back any expenses? And he's like, no, we're not managing this business for, oh my gosh, we're going to have a potential recession. He said, no, we're managing this business because we know the economy is going to grow over the next 10, 15, 20 years. That's why we're continuing to invest during these downturns. And I think that's why Jpmorgan Chase will continue to be a very successful bank in the long term. It's because, again, like us, we don't worry about the volatility. Jamie Dimon doesn't worry about the volatility of the stock price, of the economy. He's going to run the business for the long term, which is, I think, why I see a good growth rate here and why I think Jpmorgan is going to continue to do quite well. Now, talking about the dividend with the stock price pulling back here, you get a very nice dividend of 3.5%, and the company only uses 29% of their earnings to pay that out. They have been buying back a lot of stock. I know that will cease due to the CCAR, the stress test, but in the past they did buy back about 4.8% of the shares outstanding there. That was their buyback yield. We look at the balance sheet, no current ratio. That's because they are a financial company. Debt to equity at 120% is favorable compared to the industry 160%. But again, the accounting is different for financial companies, as many times assets are liabilities and loans are actually assets, is what I meant by that. The net margin is 35.2%. Industry is 30.9%. Return on equity stands at 14.2%, while the industry is at 11.2%, and return on invested capital at 7.3%. Now, looking at the current price for Jpmorgan Chase is $112.95, wow, well off the 52-week high of $172.96, and the 52-week low, $106.06. Year-to-date, the stock has definitely struggled, as it's down about 27%. Now we'll go out to, 2023, and we see that the estimated earnings per share here, well, that's $12.68. That would give us a target sell price of $210.49. So, I mean, I got to say here, Ken, I like the financial industry. They've been beaten up because of the concerns over recession. But as we kind of talked about at the beginning of the show, I think the concerns of recession have gone too far. I don't think we're going to have this deep, long recession. I think it's going to be a short, mild recession is what I'm looking for. And I think if the recession fears do come true, and in my opinion that they're not going to be as bad, I think the banks can recover quite nicely because the recession fears will abate, and the companies can then take those credit reserves off the balance sheet, which now pops back on as earnings. I think now is a great time to be looking at banks like Jpmorgan Chase.
Okay, yeah, that's what I'd hoped. After they announced their missed earnings on Thursday, the stock went down all the way to 106. And now it's popped back up just in one day. But, it looks attractive, and everything you said seems pretty positive, and especially about Jamie Dimon as a CEO. He seems to be pretty conservative as far as running the company, and also realistic on things. He's not trying to sugarcoat things, and he did put almost $500 million in reserve for possible default loans.
Yep.
He's just not hiding anything. So that's why it just seems so attractive, especially with interest rates on the way up.
Yeah, and
to go up.
Exactly. And that's kind of what I was talking about too with that credit reserve there that he did. I think many times JP Morgan is more conservative than they need to be with that, which, as I said, it doesn't impact the business necessarily in terms of their long-term earnings capacity, but in the short term, it causes them to miss earnings like they did this past week because they had to put that on the income statement as a loss. It's an expense. Well, it's not a real expense to the company. It's just an accounting method that they have to go through. And I think, as you said, they are overly conservative, which I'm okay with because it doesn't jeopardize the long-term impact for the company.
Right. So would you be a buyer at, say, 100 or 105?
You know, kind of as I was talking about there too, where I was saying you look 7 years down the road with a company like this. I mean, I like Jpmorgan Chase at these levels. I got to tell you here, you obviously got to do a little more research on it. It sounds like you did dig through the conference call and the earnings report and so forth, but I like Jpmorgan Chase at these levels. I wouldn't be trying to play this game of, is it going to dip back down to 100? I look again, where's it going to be 2, 3, 4 years down the road? I think it's going to be quite favorable for investors in the right financial companies.
Okay, great. Appreciate the information and your thoughts on it.
No worries, Ken. Thanks for calling.
All right.
All righty. Well, I do see we have Al and Stan waiting there patiently. Hold with me here. As I said, I do have our financial planner, Harrison Johnson, here with me, and about that time for financial planning, so I did want to turn it over to Harrison here and see what we're talking about. I think the topic for today is tax loss harvesting.
Tax loss harvesting, yes, sir. So tax loss harvesting is a process of selling a position that's in a taxable account at a loss, so you can use that loss as a deduction to offset the income from other capital gains or even ordinary income. One thing that's kind of cool about this is if you have long-term gains are taxed at a lower rate than short-term gains, but you can use long-term losses to offset short-term gains as long as there's no other long-term gains to offset. If there are no capital gains to offset when you realize a loss, then that capital loss can be used to offset other income such as wages. We're limited on how much we can do per year. It's $3,000 per year. It can be used as a deduction, and then the rest of that carries forward to future years. And with tax loss harvesting, we always have to watch out for a wash sale. So if you recognize a loss and you sell a position, you're not allowed to buy that same or an identical position 30 days before or after that sale. If you do, the loss is negated. You don't get to realize it. So this prevents people from selling a position that's down and then immediately buying it back just to lock in that loss and then use it to deduct. So on the surface, tax loss harvesting seems like a no-brainer. You just get a tax deduction essentially, but there are some caveats to it, and that's the main reason why I wanted to talk about this. So one risk of tax loss harvesting is you're essentially selling low, which, if you're an investor, you want to buy low, sell high. But in this case, You buy something, it goes down, you're selling low. And it's possible that, you're selling to get the deduction, but while you're waiting to then rebuy that company, again, you have to wait 30 days, it's very possible that that position goes up, and then the gain that you missed is more than the tax savings that you got from the loss to begin with. So, for example, if we use an example here, let's say you have a position, there's $100,000 in it, and it drops 10%. So now you're at $90,000, and you want to do some tax loss harvesting. So you realize this loss of $10,000. So your capital gain tax rate is 15%, so that saves you $1,500 in taxes. However, all it would take for that initial investment of now $90,000, it only takes a gain of 1.67% to recoup that entire $1,500 tax savings loss, which 1.67%, I mean, that can happen in a day. It happened yesterday. So, you have to be careful about that. Also, let's see.
And while you're looking there too, I was going to say, I mean, I've seen this happen so many times where people are so fixated on the taxes, or don't mean to knock them, but I'm going to knock them. A lot of CPAs are like, I'll just take the loss, and they don't think about the investment part coming back. And I'm going to say too, right now in a situation like we're at, I still think we're going to have a good end to the year in the market here, and in the right stocks, I should say, not the whole market. I think there's still some issues in the market, but I think the right companies can rally into the end of the year. You take that tax loss. Also, now you're playing this guessing game of what's going to happen over the next 30 days, and people know we're not short-term traders. Nobody knows what's going to happen in the next 30 days. It could pop very easily.
Exactly. You mentioned the right company, and that's exactly it, because you can't buy that same company back within 30 days, but you could buy a different company back. But the thing is, if you bought a company and then it goes down, well, you should be more excited about that company now, because if you were excited about it at that first level, now it's down, now it's an even better buy. So you really don't want to get into the practice of trying to tax loss just purely for the deduction, when in many cases you should be buying more of that company. And there's a way that you can do that. So sometimes what we look at is, instead of just selling a company and then trying to buy it back in 30 days, we'll start off with doubling that position. So buying it and doubling it, and then waiting 30 days. And then if it still makes sense to tax loss harvest, then you can sell the initial lot that you have, claim that loss. Or if the position goes up, well, that's great. You doubled your position when things are low, and then you got the benefit of the gain that's going to come out of that.
Yeah, it really, I always tell people, I like to have options. That creates, I think, much better options for you. As I said, you're not trying to play this guessing game of what's going to happen in 30 days. You look at saying, hey, I know this is a great business. I would never recommend doing the strategy with a terrible business. If you have a terrible business, cut it loose, take the tax loss. Yeah, that's a good idea. But if you have a good business that is down temporarily in your belief, yeah, that's a great way to do it, because you buy it and 30 days later, you have that option then to say, well, do I want to take the tax loss, or is this a great business I should continue to hold? The one thing I will say is you want to make sure it's not over-concentrated in your portfolio, because you double that position, all of a sudden it could be 12% of the portfolio, let's say, then the stock goes up. Now it's a huge part of the portfolio. That's something you have to be cognizant of as well when you're implementing a strategy like this.
Yeah, one last thing I want to mention on this is, when you're engaging in tax loss harvesting, this isn't a permanent deduction that you're getting. Really what you're doing is you're just extending that gain to be realized again at a future date. So if you sell a company and then buy it back after the 30 days, what you've done is you've now locked in a much lower cost basis. So if it does come back and then continue to grow, now all of that loss that you've captured is just going to be recaptured as a capital gain in the future. So one thing that you'll have to look at is, what is your tax bracket now, and then how is that going to change going forward? Because it's very possible that you could engage in tax loss harvesting maybe when you're in a 0% capital gain tax rate, if your taxable income is low enough, which, if you're a married couple, that's around $83,000 of taxable income, which means your AGI can be close to $110,000. And at that level, you don't pay any taxes on capital gains. So why would you want to lock in a loss only to have a larger gain in the future, which maybe in the future you will be in the 15% bracket or the 20% bracket? So, you also have to look at what is the real tax benefit of doing this to see if it's something worthwhile.
Yeah, and it's what it always comes down to when we talk about financial planning. It's about understanding the big picture, and that's what you do a great job of for your clients. I think that's why you become very popular in the office, is people appreciate you breaking down the whole story. And a lot of times people are just so fixated on one concept that they miss so many other ideas that actually end up costing them in the long term.
Yeah, I mean that's what financial planning is, a big picture for sure.
Yeah, and you want to have a conversation with Harrison. The first meeting with Harrison is free. You can learn more about what financial planning is. I'm going to say true financial planning is. You get this concept of financial planning. A lot of different financial planners. I'm going to tell you not what Harrison does. You want to learn how he helps his clients. You can go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Or give him a call at the office at 858-546-4306. Again, that's 858-546-4306. But with that said, let's go back to the phones. Again, phone number here if you want to join in. We may have time for a few more callers. 833-288-0973. Again, that's 833-288-0973. But let's go out to San Diego and speak with Al, who's been waiting there patiently. Hey there, Al. You're on the Smart Investing Show. How can we help you this morning?
Hi there. The stock is GOEV. It's an electrical car stock, and I hold it, and it doubled from $2 to $4 this week.
Mm-hmm. Yeah, and I do know, I saw them in the news this past week. I believe they got a contract with Walmart to sell their vans. I believe that's who that was with. So they have been, I guess, more in the developmental phase. I don't think the company has any sales. Are you aware of the company's current standing there, Al, or is they're just kind of building contracts?
I'm not aware of it, no.
Okay. Well, hey, let's take a look. As I said, I did see in the news this week they did create that partnership with Walmart. That's why the stock did pop there. 100% gain. That's pretty phenomenal in just 1 week. But let's take a look at the numbers here for, again, GOEV is the ticker symbol, so GOEV. Company name is Canoe. I think they were actually created via a SPAC, if I'm not mistaken. But short percentage of float. Wow, this may be one reason why the stock did pop. I see short percent at 22%. You may have had some shorts uncover here this past week. Institutional ownership, just 36.6%. That's quite low. I see the valuation ratios. This is what I was talking about. I don't think the company has any earnings, any sales, because there's no price to earnings multiple, no price to sales multiple. I think they're just in that phase where now they're trying to get contracts with their product, and then maybe a year or two down the road they'll start to have sales. So that is something that is quite concerning to me, as it's, I'm going to say, very speculative. Looking at the price to tangible book value, though, 4.7. That's below the industry average of 4.8. So they do have some valuable assets, I guess I'll call it, on the balance sheet. Looking at growth, there's nothing there, again, because no sales, no earnings, no dividend. Looking at the balance sheet, current ratio 1.1. That's good. They have plenty of liquidity. And debt to equity is 0.1. So they're in a good spot. I think they have enough capital to get them through, hopefully, that manufacturing phase. I would keep an eye on that debt to equity as the company does ramp, though. Looking at the current price for Canoe, it's $4.28. Wow, I see the 52-week high, though, $13.35. A huge decline from that level, especially looking at the 52-week low of $1.75. So definitely had a lot of the excitement, I guess, dissipate over last year, but that Walmart contract did help them quite a bit this past week. I see year-to-date stock still down 44.6%, even with a doubling in the stock price in 1 week. That's quite crazy to me. I do see the market cap $1.1 billion, so it is, especially with the doubling of the company, not a huge company by any means. At just again a $1.1 billion market cap. Before the increase, it appears to be they were around about $500 million. If I go forward, though, for Canoe, I go out to December 2023. I see estimated earnings per share, unfortunately, a negative $1.47. Can't derive a target sell price from that. Definitely what I call a growth story here, Al. Not a value company. It's very speculative. You're hoping that they're going to start to get more and more contracts with other companies and kind of build that business. It could be something that's a great company 10, 15, 20 years down the road, or to be quite frank with you, could go out of business. All hinges on those potential contracts, as there's no sales, no earnings, no financial statements to really break down at this point.
Okay.
All right.
Well, yeah, they actually doubled in 2 days. They went up from $2 to $5 in 2 days, Wednesday and Thursday.
Yes, I did see that, and I'm saying, though, if their contracts, or if the contract with Walmart doesn't increase the capacity that they thought it could, that could be a big negative for the stock. So it's increased over the last 2 days, which is great. I think a lot of that could again been the shorts uncovering, but it's definitely a very high risk company, is what I would say about GOEV or canoe. It's speculative. It could go up another 100%, or it could go back down another 50%. It's a risk. I'd put it at that point there, Al.
Well, I got August calls on it.
Okay. Well, we'll see what happens with the August calls there, and I wish you well, and I hope that it works out for you there. Alrighty, well, hey, thanks for calling there, Al. I appreciate it. I did see we did get another phone line there pop up, so with that, let's go out to Escondido, and let's speak with Richard. Hey there, Richard, you're on the Smart Investing Show. How can I help you this morning?
Hi, I'm looking at the GSK stock.
Alrighty, I believe, yep, this is a drug manufacturer. You hold that currently, or are you looking to buy it?
Just looking at it.
Alrighty. Well, let's take a look here at GSK. Again, they're in the drug manufacturer industry. I don't see anything on the short percentage of float. I see institutional ownership. That's strange, just 13.5%. That's quite a low level for a company that I thought was quite large. Price to earnings, 17.2, below the industry average of 21. I see price to sales also favorable at 2.4, as it's below the industry average of 4.1. Price to book value, 5.5, about the same as the industry average of 5.3. I see price to cash flow, 8.7. That's favorable compared to the industry average of 14.4. Then turn to the growth rates. Earnings over the last 1 year, well, they're up 16.4%, below the industry average of 23.2%, but that's still a pretty darn good growth rate. Sales over the last 1 year, well, they're up 10.9%, while the industry was up 14.6%. And going forward, the 5-year estimated growth rate on earnings per share, 8.2%, better than the industry average of 4.6%. I like to see that. Looking at the dividend for the company, nice dividend yield, 4.8%. The company uses 77.8% of their earnings to pay that out. A little concerning, especially with a drug company. I don't know if I would like to have a payout ratio that high, because I generally like to see them invest more in research and development and kind of growing the business there. Hoping maybe that their earnings perhaps got hit with some accounting measures and their true payout ratio isn't 77.8%. It's sustainable on the dividend, but it worries me about the long-term viability of the company there. Looking at the balance sheet for GSK, I do see the current ratio as well. That's 1.2, plenty of liquidity. Debt to equity is a little bit high at 210%. Industry is 280%, but I normally get worried if debt to equity starts to exceed 120, 140%. So 210, very, very high for a company. Looking at the profit margin, well, that's 14%, below the industry average of 19.7%. Return on equity, well, that's 31.6%. And the return on invested capital is 11.9%. So overall, I'd say there's some good numbers here, but definitely some numbers that I'm questioning. Looking at the current price for GSK, $41.25. The 52-week high, well, that's $46.97. And the 52-week low, well, that's $37.80. Now, looking forward for GSK, I go out to December 2023. I see estimated earnings per share of $3.48. That would give me a target sell price of $57.77. That is above the current price of $41.25. So there is value there, but as I kind of said, there are some numbers that I would definitely want to dive a little bit deeper into. In particular, would be that payout ratio, and also to that debt to equity is definitely a little bit high there.
All right. Thank you very much.
All right. No worries there, Richard. Thanks for calling. All right. Well, let's see. We're approaching the end of the show here. I do believe we have time for one more call. I did want to mention real quick, though, we do have our Smart Investing Workshop coming up this next Thursday. Again, that's going to be, let's see, I believe that's the 23rd. It's July 21st. That'll be at 6 p.m. in our office in the Scripps Ranch. And what we're going to talk about there is, you need an investment plan during difficult time periods like this. And that's what our firm has. Is we want to make sure we're not worried about all this volatility, and we want to stick to our investing plan. You want to learn what our investing plan is, join us at that workshop. Just register at smartinvesting2000.com. Again, that's smartinvesting2000.com, and we'll get you all signed up. It'll be the last one for a few months there, so time is ticking to attend one of those smart investing workshops. Well, with that, let's go out quickly to Michael in Chula Vista. Hey there, Michael. You're on the Smart Investing Show. How can I help you this morning?
Good morning. I'm calling about another REIT, Highwoods Properties, symbol HIW.
Alrighty, Highwood Properties, and I do believe they're in the office space, which I think long term you're going to see more people go back to the office. That's my personal opinion, but I guess we'll see what happens with the economy and how that progresses with the work from home trend. But let's take a look again at Highwood Properties. They are again in that office space. I do see that the current valuations, a price to earnings multiple of 11.9 below the industry average of 19.9, price to sales of 4.6, also below the industry average of 6.2. See price to tangible book value at 1.5, above the industry average of 0.4. That's a strange number, but price to tangible book value 1.5, I think that's a pretty darn attractive rate. Price to cash flow 8.9 below the industry average of 13.5. I see earnings over the last 1 year, well, up 25.1%. Again, I believe that could be from selling a property. Sales over the last 1 year, though, up 8.3%. And also, too, looking at the dividend here, 5.9%. Very attractive yield for this business. Looking at the balance sheet, current ratio just 0.2, and debt to equity at 1.1 or 110%. We want to understand why that company just does not have very much liquidity. That is quite strange. One area that is definitely a note of caution. Looking at the margin, 37.8% above the industry average, 32.4%. Return on equity at 12%, better than the industry average, 6.1, and return on invested capital, 7.3, also better than the industry average, 3.8. I see the current price here for Highwood is $33.72. 52-week high, $48.82. Definitely pulled back off those levels, and a lot closer to the 52-week low of $32.62. I see year-to-date stock has definitely struggled at a negative 22.5% performance there to start 2022. If I go out to December 2023, though, to look at the FFO, or again the funds from operations, I see that's $3.98. That would give us a target sell price of $66.07. So a huge potential gain there from the current level of $33.72. I like the valuation for this business here for Highwood Properties, Michael.
Thank you. Appreciate that. And I had a quick question about REITs in general.
Yeah.
As far as a portfolio balance, say you have 4 different REITs, different types, office REIT, maybe a gaming REIT, a healthcare REIT, and you had 6% of each of those companies. Are you comfortable with that, or do you consider that maybe 25% invested in real estate a little bit too much?
You know, I'm not going to say yes or no necessarily on that. I'd say it depends on the environment. If REITs do look really attractive, a 24% allocation, I don't think is too aggressive because, as you said, there are different types of REITs. It's not like you're buying, if you had 4 office REITs, I'd say, yeah, that's definitely over allocated to it. But right now, I think there are so many great opportunities. I'll tell you, we have 2 different REITs in our portfolio. We've talked about maybe adding a third. 4, maybe down the road to be something, but I don't think it's necessarily too high of an allocation, especially if you keep them in the different sectors there.
Okay, great. I appreciate that, and you have a great weekend.
All right, thank you so much. You too, Michael. All righty, well, that does pretty much wrap up the show there. Again, I did want to just throw a quick plug. We do have our workshop again coming up this Thursday. That's going to be, again, July 21st at 6 p.m. at our offices in Scripps Ranch. And we're talking about why it is so important to have that investment plan during these difficult time periods. You know, your money is hard-earned, and it is important. You want to make sure that you're investing it properly to set yourself up for retirement or also to last you through retirement. You can want to join us for that workshop. Go to smartinvesting2000.com, or you can call us at the office and ask for Priscilla. Give us a call at 858-546-4306. Again, that's 858-546-4306. And as I said, it is going to be our last one for a few months, so you want to go ahead and get registered there. Join us for that workshop, especially during these volatile times. It is so important to make sure you do have that strong investment plan.
Yeah, absolutely.
Well, we'll wind it down here. So I did want to thank Harrison for joining us this week. It was a treat having you in studio here. I'm not sure if you're going anywhere next week, but I guess time will tell.
Usually I figure that out just a few days before, so we will see. I don't think I'm doing anything next weekend, so I should be in San Diego.
Oh, very good. Well, all right. Thank you for listening. Oh, cut me off there with the closing bell, but thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Chase Wilsey, or also Brent Wilsey at 858-546-4306. Again, 888-546-4306. Please visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information along with investment tips, go to our Facebook group, Smart Investing with Brent and Chase Wilsey.
Truth